I've always thought like an individual investor.
How do you choose which BDCs to put into the fund?
2008, none of the public BDCs went under. Can't say that about banks.
What would you say are the best conditions or the best time to buy into BDCs?
This is not nirvana, but it is close.
Mike, somebody unfamiliar with business development companies might look at these 10% yields and think that looks risky. Why is it that BDCs can pay higher yields than banks or other common stocks?
You're right. I mean, I think we have been trained as investors to think that a double-digit yield means that there's some sort of trouble on the horizon. But that's not the case with BDCs. In fact, BDCs are structurally designed to provide these kind of yields in that 8 to 11% range. And the big reason is because BDCs are registered investment corporations, so they don't pay taxes at the federal level. Now, in exchange for that, they have to pay out substantially all of their income in the form of dividends to investors. So that's really the big reason why. One, they don't pay tax at the federal level. Two, they have effectively a payout ratio of about 100%.
Mike Petro is the fund manager at Putnam's business development company fund, ticker symbol PBDC. Mike, BDCs and banks could theoretically both lend to businesses. So why, from the business owner's point of view, why would a business choose a BDC over a bank?
Right. It actually goes both ways. The business owners would rather work with BDCs, and banks actually find it difficult to work with these customers. I'll kind of cover both points. First of all, the banks find it difficult to work with these companies because the Dodd-Frank Act of 2010 made it hard to lend to businesses that are what we call levered lending businesses. And these are businesses that might be levered, 4, 5, or 6 times to 1. And so that business really moved to the BDCs because it was just too expensive from a regulatory capital perspective for banks to do it. Now, it turns out that the companies would rather work with BDCs anyway for several reasons. One is the speed of execution. Banks are looking at hundreds of loans every day, and they just can't process them on a few day basis. Whereas BDCs are looking at a handful of loans at any given time and can process your loan and tell you whether they're going to give you that money or not in the space of a day or two. So that's really important. If you're trying to close a big acquisition, you need to know whether that money's going to be there or not. And you can't wait around for the bank to kind of go through its hoops and tell you 20 or 30 days later. So that's a big advantage. Secondly, is just the structuring. So like, let's say you're a smaller company and maybe you're borrowing $10 or $20 million or $30 million. You might be looking for a partner in this case. And BDCs have the ability to do co-investments of equity. So they'll make the loan, but they'll also put in some equity, and they'll be a partner, and maybe they'll be on the board, and they'll offer advice because BDCs are structured to be able to offer advice to their companies. As a matter of fact, that's one of the requirements of BDC, is that you be able to offer advice to your clients. Banks are just giving you the money in that sense. They're not going to partner with you to that same degree. On the other side, if you're a really big company, like let's say you're borrowing $5 or $6 or $700 million, banks are not going to want to hold that kind of a loan. They're going to syndicate that in the broadly syndicated loan market. And so they're going to syndicate that out to like 200 or 300 institutional investors. So again, say you're trying to do a big acquisition. Do you really want like 200 or 300 institutional investors to know exactly what you're planning to do? Or would you rather go to 2 or 3 BDCs who could keep that information secret? So for those reasons, the companies find it a lot easier to work with BDCs.
That's interesting. So a BDC can take an equity position in one of their borrowers, and banks are not allowed to do that, right?
Yeah, that's right. Now, BDCs don't always do that. I mean, there are all sorts of kinds of BDCs. Some do equity investments, some would never do that.
And if a BDC did take an equity position, would it be true to say that the upside of that, the potential return they could earn, would be even higher than the interest on a regular loan?
Yeah, that's right. I mean, some BDCs have made that part of their business model. I'm thinking ones like Main Street, for example, where they'll do an equity co-investment, and then 6, 7, 8 years later, very oftentimes they'll have a pretty good sized payout.
And from the investor's point of view, apart from the higher yield, are there any other advantages to investing in a BDC compared to just buying a regular bank stock?
Well, again, the biggest advantage really is that high current yield, because, banks are not going to have a 100% payout ratio. And they also, by the way, pay federal taxes. So that is the big advantage. But there is sort of like a black swan moment that we've had with banks. As recently as just March of 2023, we had several large banks fail. And the reason is because BDCs are levered basically 1-to-1. So for every dollar of equity, they're going to go borrow another dollar, and they're going to take those $2 and they're going to lend them out to businesses and generate income for us. Now, banks are levered like 10 or 11 times to 1. So there's more risk there just from a leverage standpoint. Now, banks are also funded typically by deposits, which usually works out perfectly fine. But, they're making loans that might be 5, 6, 10 years in duration, and they're funding them with deposits that actually could go out the door any given night of the week. Now, BDCs have done a very good job of matching their liabilities and their assets in terms of duration. And so normally this works perfectly fine for banks. But, every now and again, there's some sort of crisis. We had it in 2008. We had it in, again, just 2 years ago when Silicon Valley and First Republic that went down. And it was because their deposits fled overnight and they had asset liability mismatch, which BDCs don't have. And that 10 times leverage versus 1 times leverage is the problem too, that magnifies it. Now, 2008, none of the public BDCs went under. Can't say that about banks. Again, most of the time, not a problem. It's just every now and then you get that black swan moment that can really hit banks hard.
So I guess it's a diversification of risks. Both have their risks, but they're not the same risks.
BDCs, they do arguably have individually riskier credits, and they have less diversification. So a BDC might have, anywhere between 50 and 500 positions, loans that they've made, whereas a bank could have tens of thousands of loans.
Right. Okay.
So banks are arguably less risky on a single asset level perspective, but on the other hand, they're 10 times levered. So if anything does go wrong, it's 10 times worse. So it kind of balances out.
Okay, Mike. And from a market perspective, what would you say are the best conditions or the best time to buy into BDCs?
Well, actually, right now is a really great time. I mean, it's almost nirvana. The best circumstances are when rates are relatively high, yet the economy is still moving forward. Now, you don't need the economy to be great. You just need it to be okay and not going down. And that's really what we have now. And we had even better, I would say, a year ago, we had rates, or 9 months ago, we had rates 100 basis points higher. So it was even better than it is now. But now it's still really great. Again, the economy is strong and interest rates are high. So BDCs are making more money. So it's a great time.
I don't see a lot of coverage of BDCs in the financial media. Why do you think that is?
Well, they are a little esoteric. I mean, the accounting is a little bit different. They have mark-to-market accounting. They mark their assets and liabilities to market every quarter. Banks don't have to do that. So it is a little bit different accounting, which I think makes it a little harder for the street to kind of get their head around it. But I think the biggest reason really is because they're not in the indices. They're not in the small cap 600. They're not in the Russell 2000. And the reason why is because of what we call AFFE, the Acquired Fund Fee and Expenses Rule. And this is an SEC rule which says that if a mutual fund or an ETF owns a BDC, that mutual fund or ETF is going to have to include all of the fees and expenses of the underlying BDC as if it were their own fees and expenses. And that's why if you look, like PBDC or BIZD has an expense ratio that's double digits. Now, that's not really what we get paid. I can tell you, I mean, we get 75 basis points. We don't get 14%. But just to just give you an idea like how crazy this is, the fees and expenses that we have to include, that PBDC has to include the interest expense of the BDC. Now, the BDC is in the business of borrowing money and then lending it out and making more money, just like banks are. So I would call the interest expense that a BDC pays for the money it borrows like a regular cost of doing business. That's like cost of goods sold almost, right? But for whatever reason, the SEC decided, no, the interest cost of the BDC has to be included in PBDC's expense structure. It kind of boggles the mind, really. But anyway, the indices, the index providers, Russell and S&P, have decided like if they were to make BDCs be in the index and then have index funds own it, those 10 basis point fees would be like 40 basis points, and that would drive the index funds crazy. So they have decided not to let BDCs into the index. Now, there's some hope that might change, but for right now, it makes no sense at all. The real fee, again, for PBDC is 75 basis points.
Right. I'm glad you mentioned that because I get a lot of comments every time I mention BDC funds like yours asking about that percentage of 13.94, I think it is. And I'm sure it's not something you want to put on the website. It's an SEC regulation, right, that requires that.
Yeah, there's nothing we can do about it, but it's not real money.
Right. Okay. I'm glad you cleared that up. Are there any other misconceptions that are common to BDCs or BDC funds?
Years and years ago when BDCs first came out, if you go like 15, 20 years ago, I think they weren't good at credit. I think they were good at raising assets. They weren't necessarily good at making loans they're going to get paid back. And I think they developed a reputation as being very risky. And that might have been deserved, 20 years ago. But the BDC business has evolved so much. It's really hard to state how big the change is. I mean, it's just become so professionalized. Like now you have companies like Sixth Street, you've Golub Capital, you have Bain Capital, you've got these big names, KKR, Goldman. These are people who know what they're doing, who know something about running a business. So if they have to take over the business, they actually know how to do that, which, by the way, is another advantage that BDCs have over banks. They can turn companies around. But I think that's a big misconception. And if you look actually at the long-term credit history, I have data going back 20 years. The annualized average loss rates for BDCs are 92 basis points versus 90 basis points for a broadly syndicated loan fund, which you would know is a floating rate fund, and versus about 145 basis points per year for high yield bond fund. So it's really about the same as a floating rate fund, and it's actually quite a bit better than a high yield fund. And you're getting those better yields than in both of those cases. So I think that's a big misconception. Credit a lot better than people think.
And yours is not the first BDC fund. We'll get to one of your competitors in a minute. But what was it that made you, because you're the original fund manager for PBDC, right?
That's right. That's right.
Yeah. So what was the catalyst to launching this fund in the first place when there were already other BDC funds out there?
Yeah, I started my career as an individual investor. I sort of was a very active amateur as an electrical engineer, and then I decided to go pro as a professional investor. I was able to do that, but I've always thought like an individual investor, and I've always thought, well, what do people need? And back in the era, we had many years of zero interest rates, and there was just no income to be found whatsoever, really, from anywhere. And I saw BDCs and I thought, wow, these are, at the time, they're yielding like 7 or 8%, which is phenomenal. And I thought, this is something that people need. Like, there's no income out there. And this is something that people really, really need. And I've been in this space for a long time. I've been looking at the BDCs for more than 17 years. And I thought, I can add value here. Like, there's a lot of alpha to be had. There's a good current income. I can give investors high current income and, chance to add several hundred basis points a year of alpha on top of that. And I just thought it was a really compelling opportunity that really met a market need that existed out there, and I think still exists. And, we got seed funding from Putnam in November 2017. So we actually have a 7-year record. If you're looking in the prospectus, there actually is 7 years of data back there, even though the fund itself only launched, it's September of 22. So it's a little more 2 years. There actually is a 7-year track record in there.
I wasn't aware of that. So what format was the fund in prior to 2022?
Yeah, so it was private seeded capital from Putnam. I mean, individual investors wouldn't have been able to access it back then, but it was the same process with me as the portfolio manager, doing exactly what I'm doing right now with just BDCs and basically exactly the same thing. So now we have an ETF wrapper instead of a separate account.
In the BDC universe, there's roughly 45, 50 BDCs, and in your fund, you don't hold all of those. You select, because it's actively managed, which funds you hold. So how do you choose which BDCs to put into the fund?
Right. So as I said, I've been looking at BDCs for more than 17 years. And so I really, know all the management teams pretty well. I have a good idea of how they think about investing, what kind of loans they make or don't make. And I have a pretty good idea of how they're going to perform in various situations. And so I'm always thinking about, well, where are we in the economy, and, how much risk should we be taking, and what does that mean for the kind of BDC we want to own? So, for example, if I thought that there was going to be a recession, I would want to own BDCs that are more focused on senior secured first lien loans. That would be somebody like Blackstone. And by the way, they lend to very large companies too, which are going to be doing better in recession. Now, if you go back to like 2021, I was on a panel and somebody asked me, "Well, Mike, what's your best idea?" And at that time, I said Pennant Park. Now, Pennant at that time had 32% of its assets in equities, much of which they got the hard way, by defaults, and then they owned the company. But if you go back to 2021, asset valuations were rapidly inflating. The economy was rapidly inflating. And so you were going to see marks up on positions, and you're going to get a better mark up on an equity than you are on a loan. So I knew that net asset value, right? I was pretty sure net asset value was going to be climbing rapidly because of where we were in the economy and the markets at that time. And then also they had, a third of their assets were in equities that were not producing income. The idea was that they could use this hot market to liquidate some of those positions, sell them off to private equity or strategics or whoever, and then take that cash and reinvest it in income producing assets, which would allow them to increase the dividend. So that was a very good story. And in fact, they were able to execute on that, not as much as I wanted, but partially. They were able to sell some of the positions, increase their dividend, and the stock worked really nicely. Now, fast forward to, 2022, 2023, today, that's I would say a riskier position, and I think is maybe not the time to take that kind of a risk. So sometimes you want to take risk and sometimes you don't. And so then I have to think, well, what is the right vehicle for that? In 2021, it was Pennant. Now I'm more conservative. I'm going to be more in, things like Blackstone, in Sixth Street. Just another quick story. Josh Easterly is the CEO of Sixth Street. I think he's one of the smartest CEOs in the business. And, we go way back. And so at one point he said to me, he said, "Mike, like, why are you underweight my stock?" And I said, "Josh, I love you. I think you run a great BDC, but, what you do is you swap out all of your liabilities to floating rate. So you might make a fixed rate, you issue a fixed rate bond, but you're going to swap that out to floating because you want to eliminate interest rate risk. You don't want to take interest rate risk. You want to just take credit risk. And that's great. But, this is like, 2021, 2022, and rates were going up, up, up. And I said, that's great. I mean, but right now I want the interest rate risk. I want BDCs that are going to make more money as rates go up. And so that's what I was doing. But now as rates, topped out and started to come down, I added a lot to Sixth Street. So now I'm actually quite overweight Sixth Street because they're going to do better as rates come down. So it's thinking about where we are in the economy, how much risk to take, where we are in the interest rate cycle. Do I want things that are more exposed to rates going higher or lower or not?
And what about pricing then? Because some BDCs like Main Street, Hercules, trade at high multiples of their asset value. And as cycles of the market, come and go, these prices will vary. Are you looking to trade in and out based on valuation, or is it more about what's happening behind the scenes, as you were describing?
Right. That's a great point. It's all what I said before about kind of, macro factors, but I absolutely am looking for sort of idiosyncratic turnarounds in BDCs. And for example, one stock we have owned in the past and then we sold because they were sort of underperforming in credit was Runway, RWAY. And they had some credit issues and like their biggest position was on non-accrual, and they had non-accruals of about 4.7%, I think it was. This is just very recent. This is just this fall. And their biggest position was a company called Snagajob, recruiting business. But it turns out that a couple months ago, they were able to find a buyer for that name, and they sold that big position. So when they report numbers in, for Q4, they're probably going to have their net asset value go up by, 10 or more cents per share. And they're also going to have their non-accruals drop quite substantially from 4.7 to, I don't know, probably by 2 or 3 points. So, that was a stock we were able to acquire for, 80% or less of net asset value that we think can trade a lot closer to 1x, if not better, net asset value. So that's, opportunity that we've pursued just very recently, as a matter of fact. So yeah, we absolutely see turnarounds like that. Another one is mid cap, which used to be called Apollo. Apollo, despite their strong history in private equity, had kind of a weak credit record in their BDC, and we had avoided it for many years. But to their credit, they realized they had a problem, so they went and they acquired Midcap Financial, who has very strong credit. And in fact, they took that guy and made him in charge of Apollo, and they renamed the thing to Midcap. So the old Apollo is now Midcap, and Midcap is actually very good. But I think it's taken a long time for the market to appreciate that this is not the same old Apollo. It's actually the good Midcap. So that's a stock that we've held, a BDC we've held that's done very well, and is continuing to kind of move up in valuation as we go here, because it's just simply a better company than I think people realize.
Okay, it sounds like, you have a tremendous amount of insight into these BDCs, and there are quite a few of them. They're obviously not all created equal. I guess the most well-established and largest BDC fund, BIZD or BIZD, that fund is one that has attracted a lot of capital. But interestingly, if you compare the total return of your PBDC versus that fund since you launched your fund, yours has outperformed BIZD in total return. So why is that? Why has PBDC done better than BIZD?
Well, I think it really just comes down to active management. I mean, that's really what I'm offering. If you look at our holdings, they have, I think, 25 names. We have 20. They have the top three. Their top three names are, I think, 44% of their portfolio. Our top three are less than 31%. So, we're probably a little more diversified, if you will, even though we have fewer names. Their top position is Ares. Our top position is Ares as well. It's a good company. Yeah, it is. Yeah, it is. They have 22.2% in Ares. We have 12% in Ares. So
Okay.
I would say we probably have maybe a little less risk from individual names. But the real answer there is just the stock selection that I can do, and leveraging, again, my 17 plus years of experience in this space. I'm trying to beat the S&P BDC index. They are not. They are trying to match an index.
But basically, as funds flow into their fund, they're just buying whatever's in the index, whether it's priced well, whether it's excessively valued, whether there's credit issues or not. They have to follow whatever the index is doing.
Yeah, that's right. And, it's as important as what I hold is also equally important as what I don't hold. Right. So we've, I think been able to differentiate ourselves by, not holding some names that have, really done poorly.
And it would be a bad strategy, even though the yields are really high for BDCs, it would be a bad strategy to just buy the 10 that have the highest yields, for example.
Yeah, that's right. We opened the conversation talking about how high yield is not necessarily an indicator of distress in BDCs. But there is a little bit of truth to that, even with BDCs. So, our yield is like 9%. I think BIZD is a little more than 10%. So they have a higher yield, actually. And that's been true the whole, 2+ years we've been public. But again, as you point out, the total return is what really matters. And, our total return has been, I don't know, cumulatively, it's probably 8 or 9 points better than BIZD.
Yeah, the last time I looked, of course, it depends on the time period you plug in, but the last time I looked, it was about 10% ahead. Your fund was about 10% ahead. Let's turn now to what's happening in the market and the economy in general. With the shift in administration, there's a lot of talk about deregulation, perhaps more mergers and acquisitions, more IPOs. What effect would that have on the BDC sector?
Well, it actually would be good, and especially for a company like Ares, because BDCs they have sort of two special items with the way they get paid. Like, one is that they have end-of-term payments. So if a loan gets paid early, then that end-of-term payment gets realized sooner than the BDC would have otherwise expected. And so rotation in the loans, like turnover in the loans, is actually a good thing. So if you have a loan and then it goes only 2 years and then gets paid back, and it was supposed to be made for 5 years, like that's a good thing, as long as you could then find another home for that money, because instead of getting that end of term payment at the end of 5 years, you get it into 2. So that's one thing. The other thing is that BDCs also get origination fees. So every time they write a loan, every time they underwrite a loan and fund it, they're going to get some 50 or 100 basis points of origination fee. And to the extent that you have, again, this higher velocity, which would be caused by merger and acquisitions, merger and acquisitions mean that there's going to be more private equity doing more deals, more sales of companies that BDCs have lent money to. So those are going to be refinanced, more loans to be made for new acquisitions, just more velocity. That's all going to increase BDC earnings.
Speaking of increased velocity, if interest rates continue to come down, we don't know if that will happen, but let's say that there are more cuts from the Fed. Would that increase the velocity, the demand for loans from BDCs?
Yeah, theoretically it would. I mean, that's what we've kind of been expecting. I mean, I think most people thought that 2024 was going to be a better year for M&A than it ended up being. So I think it's kind of like always next year. But I think the economy, animal spirits seem to be improving, and we have some stability in interest rates. They certainly stopped going up. So I think that gives private equity a little bit of runway to kind of plan and make predictions about how these businesses are going to behave. And so it's just more conducive to a more active M&A picture. So yeah, I would think it would be a little bit better. Now, of course, rates coming down by themselves are not good for BDCs, but they will be offset to some extent by this increased velocity.
Right. And I'm glad you mentioned that, because you said that right now is a good time for BDCs, the way things are looking. And we just came off a period that was perhaps the perfect time when rates were high, the economy was good. During that period, there was a lot of special dividends paid out. I mean, huge income for BDC shareholders. As rates have come down a bit, I've seen quite a few questions in my comment section about, okay, rates are coming down. That'll be the end of the special dividends. Dividends are going to be cut. Should we get out of BDCs? Would you say that's an oversimplification, that when rates come down, there's some good, some bad, but generally any good BDC can navigate through that?
Yeah, I mean, they've tried to train investors before this moment. BDCs knew that this was, a perfect scenario and it wasn't going to last forever. Now, I do want to reiterate what I said, which is this is not nirvana, but it is close. Like, this is still a very good environment right now. But BDCs have tried to kind of communicate that the era we were in a year ago was really very good and not necessarily sustainable. So what they did is they made these base dividends, and then they would have these supplemental dividends. And so, like, if a BDC earned 50 cents in a quarter, they might give you a 40-cent regular dividend, and then they would give you sort of like half the distance, like 5 cents in a special, and then they would put the other 5 cents into an increase in net asset value. Now, eventually, they're going to have to pay that out. BDCs can maintain basically a rolling 3-quarter buffer of earnings that they don't have to pay out. So eventually, you have to kind of catch up, but not for a while. So with rates down 100 basis points, you've seen some of these supplementals be diminished. I think if rates were to go down another 100 basis points from here, then you would see basically like all of those supplemental dividends would pretty much dry up. You would still have your base dividends, which would still be a very attractive yield, but it wouldn't be quite as good as it is right now. If rates go down, 200 or 300 basis points from here, then you would see cuts in the base dividends, yes. But it would still be pretty attractive, and would be a lot better than whatever else you got out there. I mean, if rates go down 300 basis points from here, like, rates are going to go down on everything. So BDCs would still be relatively attractive. But then, of course, credit would be the big question.
And when we're talking about these yields, let's say we're talking about a yield of 10%. On most websites, financial websites, the yield quoted for a BDC is the base dividend, not the supplemental dividends that we've been talking about, right?
Right. Yeah. You have to look carefully and calculate yourself.
Yeah. So if you're expecting recently in the last couple of years, say you've got a BDC that yields 10, you might have actually received more than 10 because of I guess, these little Christmas gifts or unexpected surprises of these supplemental dividends?
I don't know if it was maybe 10. I would say maybe more like 9. And then you ended up with like 10 and a half, 11 maybe.
Right. Okay.
Yeah, but it's still going to be very good.
Yeah, that extra 1.5% has been nice. But
Yeah.
just to wrap it up, then, if we look to the future, you've already mentioned that you think if rates come down, supplementals will be reduced, but perhaps the base dividend is likely to remain. What's your general outlook for the next 1 or 2 years for BDCs in general?
Well, I'm positive on it. I mean, I was worried. If you asked me this question, 6 months ago or 9 months ago, I would have been a lot more worried, because then I thought, well, rates are going down, and we were much more sure that rates were going to go down back then. And it looked like we were maybe going to be in a recession, which is a very negative scenario for BDCs, recession with rates down. Sort of like the opposite of the great scenario. But now, there are even people out there who are saying, well, gosh, the next Fed move is going to be up. So there is absolutely no certainty. I mean, I'm talking about 100 basis points, more decrease, and we'll lose all the supplementals. There is no assurance that the Fed is going to move down 100 basis points in the next 12 months. It's a very uncertain thing. So I think that certainty in interest rates is actually helpful for BDCs. You're going to have higher for longer, effectively. So I think as long as the economy hangs in there, we could end up in a situation like we are now, where rates are where they are. I mean, gosh, maybe they go down 50 basis points more, still be very, very attractive. I think we're in a good situation for the next year or two.
Well, that's a good note to end on. Mike, thanks for explaining business development companies. I really appreciate your time.
Thank you very much for having me.
Well, that wraps it up for this look at business development companies and the PBDC fund with Mike Petro. More Armchair Income coming soon.
Armchair Income, that's my hustle and my groove.